For decades, the global standard for a balanced investment portfolio has been simple. Put 60% of your capital into stocks for growth and 40% into bonds for safety. It looks neat, it feels secure. But in the Chinese market, allocating capital by these broad labels masks a deep structural imbalance. Because Chinese equities carry 10 times the internal volatility of domestic bonds, a portfolio divided 60-40 by capital is actually allocating almost 100% of its total risk to the stock market. When equities swing, they drag the entire portfolio with them. To accurately measure what drives returns, we have to look past the surface labels of stocks and bonds and X-ray the market. This requires shifting from capital allocation to risk budgeting using a multi-asset class, or MAC, model. The MAC framework strips away the overlap between assets to reveal 8 distinct underlying macro risks. These Tier 1 factors are equity beta, interest rates, credit spreads, pure inflation, commodities, the currency exchange rate, home bias, which tracks domestic versus global strength, and real estate. These 8 factors operate as the true skeleton of the financial system. To see how they dictate market behavior, we can test this framework against the macroeconomic shocks that have hit China over the last 2 decades. Between 2007 and 2009, the global financial crisis triggered a sharp collapse in demand. Over this stretch, Chinese equities and the real estate sector shed massive value simultaneously, eroding traditional wealth portfolios. In the exact moments the stock market plummeted, capital rushed toward government debt. This flight to safety, aided by monetary easing, pushed bond prices rapidly higher. The underlying interest rates factor acted as a crisis hedge, delivering positive returns exactly when the portfolio needed protection. But a hedge in one environment can become a vulnerability in another. From 2010 to 2012, soaring domestic prices forced the central bank to hike reserve requirements and interest rates. This tight money environment lowered corporate valuations, while the rising yields drove bond prices down. The method of using bonds to balance stocks failed. Both dropped. The only major macro factor to survive and post positive returns was commodities, which acted as a physical carrier of the inflation shock. This chart breaks down the direction and volatility of each factor across different historical phases. If we look at 2013, row R3, we see clear negative markers for both rates and credit. That year, a sudden interbank liquidity squeeze sent short-term rates spiking, causing even the safest government bonds to experience a rapid sell-off. A sudden shock to the macro environment can overwrite the normal behavior of any asset class. When liquidity dries up, the safety net disappears. Between late 2014 and 2015, highly leveraged shadow financing fueled an explosive equity bull market. When regulators stepped in to force that leverage out of the system, it triggered a liquidity-negative feedback loop, leading to market-wide sell-offs and extreme daily price limits. At the same time, the central bank adjusted the exchange rate mechanism. The yuan depreciated against the dollar, activating the currency risk factor. The falling currency aligned with the crashing stock market, creating a compounding effect that intensified the pressure on domestic assets. By 2018, the system faced a dual assault.
Domestically, strict new asset management rules aggressively reduced corporate leverage. Externally, severe trade disputes created massive uncertainty for manufacturers and exporters. Under this maximum pressure, the illusion of diversification vanished. Equities plummeted on trade fears. Corporate credit spreads blew out as private companies defaulted. The yuan depreciated sharply. Equity, credit, and currency crashed at the exact same time. During periods of maximum systemic pressure, the specific behaviors of equity, credit, and currency consolidate into a single concentrated risk. The theoretical protection of holding different asset classes simply vanishes. Following a brief concentrated rally driven by foreign capital and tech giants between 2019 and 2021, the Chinese market splintered. Broad economic cycles ended, replaced by structural shifts that decoupled growth from traditional drivers. The most visible fracture occurred in property.
Strict 3 red lines debt regulations cut off financing to highly leveraged developers. Companies defaulted, construction stalled, and the real estate risk factor collapsed on its own logic, disconnected from the broader economy. Simultaneously, the home bias factor, which measures domestic strength against global markets, turned negative. As geopolitical tensions rose and U.S. interest rates climbed, foreign capital systematically rotated out of Chinese assets. Facing shrinking equity valuations and a stalled property market, massive amounts of domestic capital flooded into fixed income. This created a multi-year bull market in government bonds,
pushing yields to historic lows as investors sought the only remaining safe haven. These combined events indicate that the Chinese market is moving away from the cyclical booms of the past toward a long-term rebalancing of its economic engines. Moving into the 15th five-year plan, the economy has formed a K-shape. The upper arm of the K is rising, driven by advanced manufacturing, AI hardware, and renewable energy. High-tech production is the primary engine for growth. The lower arm of the K points downward. Consumer demand remains weak, private investment is sluggish, and households are actively paying down debt rather than spending. The economy is expanding, but the benefits are highly concentrated in specific industrial sectors. This lack of private borrowing creates an asset famine, where excess cash floods into the safety of government debt and pushes yields toward historic lows. To prevent a liquidity trap or a speculative bubble, the central bank has begun selling its own long-dated bond holdings to keep interest rates within a preferred range. This active management of the yield curve marks a significant evolution in maintaining financial stability. To fund the top half of the K-shape while stabilizing the bottom, the government is issuing ultra-long special sovereign bonds. This shifts the debt burden away from strained local municipalities and onto the central government's balance sheet, lowering the cost of borrowing for major projects. We are left with a fractured economy where tech manufacturing accelerates, real estate deleverages, and the central bank manages the yield curve. Relying on simple asset labels in this environment is a risk. Survival requires discarding money allocation and strictly budgeting the underlying macro risks.